All right, welcome back, everyone. To all the institutional investors and portfolio managers tuning into this week's Explainer, I am absolutely thrilled to walk you through our latest market analysis. We've got some fascinating price action and macroeconomic data to unpack from this holiday-shortened trading week. We're really going to dig into the underlying shifts that drove capital reallocation over the past few days. But just noting right off the bat before we dive in, please remember that this briefing is strictly for educational purposes and definitely does not constitute financial advice. Okay, let's get into it.
So here's our top-down agenda for today. We'll be covering broad market performance, sector rotation dynamics, key equity movements, macroeconomic indicators, and finally, we'll wrap things up with our strategic outlook.
Let's jump right into Section 1, Broad Market Performance, looking specifically at index divergence in a shortened week.
Even with the holiday cutting our trading week short, the market action was frankly pretty massive. The absolute crucial data point you need to keep in mind here is 52,900. The Dow Jones Industrial Average just smashed records to close at a fresh all-time high right above that level. But, here's where it gets interesting. Look at the divergence. While the Dow was peaking, the S&P 500 and the Nasdaq actually experienced these midweek dips before eventually bouncing back. This divergence is really our first major indicator that broad-based buying is taking a breather in favor of targeted rotation.
Moving right along to Section 2, Sector Rotation Dynamics, let's analyze exactly how this capital is being reallocated.
This table brilliantly illustrates the real story of the week. Look at that definitive shift in sector leadership. Capital was flowing aggressively into communication services and financials. Both of those sectors acted as prime targets for inflows, posting gains of over 2%. Conversely, technology hit a notably rough patch, dropping over 2%. So why the sudden drop? Well, we're seeing some heavy profit-taking. Investors are deliberately rotating out of those high-flying semiconductor stocks, which, let's not forget, had already surged more than 80% in just the first half of the year. Honestly, this is classic, textbook capital rotation at play.
All right, Section 3. Key equity movements. We're zooming in on the granular impacts of valuation fatigue.
When we look closely at this tech and hardware pullback, we are talking about serious institutional-sized declines. Micron sank as much as 10%, and Applied Materials dropped over 7%. But actually, perhaps the most telling metric of this valuation fatigue is Tesla. The stock fell about 7.5%, and that is despite them reporting really strong delivery numbers. When your foundational metrics look that good, but the equity still drops heavily, that's a huge red flag signaling a distinct shift in institutional sentiment toward AI valuations.
But as we know, capital doesn't just evaporate, right? It reallocates. We saw money move super efficiently into reliable market stalwarts like Apple, which surged nearly 5% in a single trading session. Alongside that, you had McDonald's and Disney climbing around 4%. And, just proving that there's still a massive appetite out there for fresh equity, Bending Spoons, the Italian software company that actually owns legacy brands like AOL and Vimeo, enjoyed a massive 40% pop on its Nasdaq debut.
Adding some fuel to this narrative of tech valuation fatigue, we absolutely have to consider the macro headlines driving the institutional narrative right now. Meta announced plans to potentially monetize its excess compute capacity, while reports started swirling that OpenAI is in talks to sell a stake to the U.S. government. For us as portfolio managers, these two headlines signal a critical shift. Big tech's aggressive, seemingly boundless AI capital expenditure might finally be leveling off. The infrastructure build-out phase is transitioning, and the market is actively pricing that in.
Which brings us perfectly to Section 4, Macroeconomic Indicators. Let's talk about the catalyst behind all this reallocation.
Honestly, it all comes down to the labor market. The June non-farm payrolls report was just a massive, completely unexpected miss. The consensus expectation from economists was a solid 115,000 jobs, but the actual print for June, a really stark 57,000 jobs. And to make matters worse, this dramatic downside miss was compounded by downward revisions to the previous month's data in May.
So how did institutional desks actually trade this news? This step-by-step logic chain breaks it down perfectly. Step 1. We get that substantially weaker labor data of 57,000 jobs. Step 2. This immediate labor cooling severely reduces the probability that the Federal Reserve is going to hike rates any further. Step 3. The easing of those rate hike fears directly injects a wave of positive sentiment into the broader market. It's wild, but paradoxically, this soft jobs report worked perfectly in the equity market's favor, lifting non-tech sectors and really supporting the Dow's record run.
Finally, Section 5, Strategic Outlook. How are we navigating forward? As institutional portfolio managers, our job is to always be looking around the next corner. The Dow is sitting at record highs while semiconductor stocks have finally cooled off after a truly historic run. A soft jobs report has given the broader market some much-needed breathing room from the Fed. So as you monitor the upcoming Federal Reserve commentary in the days ahead, I want to leave you with this final absolutely crucial thought to model into your risk assessments. Is this rotation out of technology a permanent structural shift in market leadership? Or are we simply looking at the perfect dip buying opportunity before the next big leg up? Thank you so much for joining this explainer, and I look forward to analyzing the data with you again next time.